All right, let's dive into one of the most confusing and frankly dramatic earnings reactions we've seen this quarter. We're talking about Cigna Group. On the surface, they reported a really solid third quarter, but the market's reaction? It was anything but solid. It sent shockwaves, and we're going to figure out exactly why.
So here's the paradox right here. On one side, you got the headlines everyone wants to see. Adjusted earnings per share beat what the analysts were expecting, and revenue jumped a very healthy 10% from last year. But then you look at the other side, and you see the market's brutal verdict, an intraday stock plunge of over 17%. I mean, a beat on both the top and bottom line almost never, ever leads to a company's worst trading day in years.
And that, right there, is the big mystery we're going to solve today. What on earth was said on that earnings call that just completely wiped out all the good news from the numbers? It's a classic case of the headline hiding a much, much more complicated story.
Okay, so to really understand the shock, you first have to appreciate just how good the initial report actually looked. Let's just quickly run through the numbers that dropped before the market even opened.
First up, the all-important bottom line. Cigna posted adjusted earnings per share of $7.83. That was a clear beat over the Wall Street consensus of $7.65. That's a great signal, right? Shows operational efficiency, profitability, everything's looking good. And the top line was just as impressive. Total revenue clocked in at nearly $70 billion. That's up a full 10% from the same quarter last year. And this isn't some tiny beat. It's a sign of some seriously robust business growth.
And you know, where that growth came from is really key. The real powerhouse here was Cigna's health services segment, Evernorth. Its revenue just soared 15% to over $60 billion. This part of the business, which includes their huge pharmacy benefit manager, was clearly the engine pushing the whole company forward.
And to top it all off, management basically stood up and said, "We've got this." They reaffirmed their full-year forecast, telling investors they were absolutely on track to deliver at least $29.60 in adjusted EPS for the year. So a beat, strong growth, and reaffirmed guidance. So far, so good, right? Well, that rosy picture didn't last long. See, after the press release comes the conference call, and during the Q&A session, management dropped a couple of comments that completely flipped the script. This is exactly where the story took a very sharp and painful turn.
This is what the market really heard. It was a 1-2-3 punch. First, Cigna had renewed contracts with 3 massive clients, but at less favorable prices. Second, they explicitly warned everyone about margin pressure in their huge pharmacy benefit business for the next 2 years. And third, they said they'd need to sink a lot of money into launching a completely new business model. Bam, bam, bam.
And the sheer scale of this is what really stunned people. The contracts with Prime Therapeutics, the Department of Defense, and Centene. Together, they represent a staggering $90 billion in annual revenue. Now, securing that revenue for the long term is a good thing, but the trade-off, accepting lower profits to do it, that was the first major red flag for investors.
And they weren't subtle about it. Management didn't hint at a possibility. They put it right out there with this statement. This confirmation of margin pressure is what sent everyone running for the exits. You know, the market hates uncertainty, but it hates the certainty of lower profits even more. But Cigna's management tried to frame this not as a setback, but as this bold, strategic pivot. They basically argued that all this near-term pain was necessary to, quote, future-proof the business. The idea was to move towards a more transparent, more sustainable model.
Now, for anyone who's not super familiar, a PBM, a pharmacy benefit manager, is the powerful middleman in the U.S. drug pricing game. They are the absolute core of Cigna's Evernorth business, and let's be honest, they've been under intense political and regulatory heat for years over their complicated and, let's say, less than transparent rebate system.
So here's the game plan they laid out. Step 1, lock down those huge contracts, even if it means taking a hit on margins. Step 2, announce this new, simpler, rebate-free PBM model. Step 3, spend the next 2 years and a ton of money to transition the business. By 2028, they expect this to be their standard way of doing things for more than half their business.
So, according to Cigna, this new model is a win for everybody. Patients get lower, clearer prices at the pharmacy counter. Employers get predictable costs. Pharmacists get paid more fairly. And Cigna? They get a simpler business that they think is way better positioned for long-term growth in a world that is getting pretty tired of the old rebate games.
Okay, so that brings us to our analysis. How should investors really look at this? How do you weigh the guaranteed short-term pain against that very ambitious long-term vision?
Well, let's break it down. The bull case is that Cigna is being smart here. They're getting ahead of regulations, they're locking down huge revenue streams, and they can hopefully offset some of this PBM weakness with their other strong segments. But the bear case, well, it's simple. You've got 2 years of confirmed margin pressure, high transition costs, and a lot of risk that this massive pivot just doesn't go as planned. In fact, in 2026, that entire Evernorth growth engine is actually expected to see its operating income fall slightly.
Ultimately, the market is a short-term voting machine. It saw 2 years of guaranteed pain and just sold the stock first and asked questions later. The potential for that long-term strategic gain was completely buried by the immediate financial reset.
So this sets up a really fascinating dynamic for the next earnings call. What should we all be watching for when Cigna reports its fourth quarter results?
Here are the 4 things you need to focus on. First, management only said they expect earnings per share to grow in 2026. That's not good enough. The market will demand more specifics. Second, any early data on how clients are reacting to this new model will be absolutely critical. Third, how do Cigna's competitors respond? Do they follow their lead? And finally, they have to show that their traditional healthcare insurance business is stable to prove the rest of the company is strong enough to handle this transition.
So, where do we land? We're initiating with a market perform rating. Look, the underlying business is still strong, and the strategic pivot makes a lot of sense. It might even be necessary. However, the confirmed margin reset in their biggest segment creates a massive headwind and a lot of execution risk that, for now, justifies the stock's lower valuation. The story isn't broken, but it's in a multi-year transition, and the visibility is just too cloudy right now for an outperform rating.
This is not financial advice.